From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, bond traders all but settled on a skip in June, even after a red-hot jobs report for May. And all his warnings about a wave of corporate defaults pile up. We begin with the big issue, a skip and then what?
The U.S. economy remains a major engine of job creation.
Where's the tightness? I think you can pause.
Powell really said pretty strongly, saying we have the luxury to wait.
They've characterized it as a skip because they think that they'll probably have to do a little bit more.
The Fed will probably be done for the cycle if they skip in June, would be my guess.
For the Fed, yeah, it's a pause or a skip. Sorry, it's a skip.
My guess is this will be consistent with a skip.
Joining us now, Lyngen of BMO Capital Markets and George Bory of Allspring Global Investments here on set, which is particularly thrilling. Lyngen, I want to start with you. Is June a live meeting?
It's a live meeting insofar as we'll get updated SEP. We'll know more about the dot plot, but the Fed isn't going to hike. They've already said that they're not going to. If you look at what the market is pricing in, the market's attention has shifted to July, and there's a high probability that a July meeting will actually see a rate hike according to market pricing. Not our call. The one thing we are confident about is that they're not going in August.
Not going in August. July's not your call either. Is the Fed done?
I think that the Fed has reached terminal, and they're very cognizant that as the TGA is replenished with a lot of bill issuance over the course of the next 3 or 4 months, there's going to be QT coming from Yellen for all intents and purposes, and risk assets might take a hit on that. So they are going to be cautious at this stage.
And we're definitely going to get to T-bill issuance. But OK, George, we have the Lyngen view. Let me bring you the Priya Ms. review of TD Securities, because I thought this was interesting. In the wake of the report, she said, very strong pay report, upward revisions. The Fed is likely to hike in June. That is our base case, a June hike. What's your base case? What's the George Bory view?
So our base case view is a pause or a skip. I'm not sure it matters what you call it, but basically a pause. And then they can continue along the path of data watching. I think the expectation is the hope that inflation continues to notch lower. But as Ian mentioned, sort of the heat is still on, and so they may need to raise rates again. Our view is that they're on hold for an extended period of time, and that will allow monetary policy to continue to do its work behind the scenes. As we mentioned, you've got QT also happening. So there's enough tightness in the system to continue to contain both growth and ultimately inflation.
Well, you bring up the difference between a pause and a skip. And at some point, I mean, we are torturing the English language. But there was a really interesting note out from Winthin, of course, of Brown Brothers Harriman. He wrote that I think the Fed is getting a bit too cutesy with its skip versus pause debate with regards to the June FOMC. Does the extra month between the June and the July meetings really make a difference? And then, George, you look at what the market is pricing. And as Ian pointed out, there is pricing for a hike in July. What's going to change potentially between June and July?
Well, inflation data. I think obviously the job market's pretty robust. You can debate whether there's some underlying softening, but the job market's fairly robust. Growth is slowing. And we've seen kind of corporate profitability is very kind of diverse. And so there are sort of signs of this kind of very gradual slowdown. But it ultimately comes down to inflation. Mm-hmm. If core inflation is not coming down, well, then it may not, even if they sort of paused for 2 meetings, and as Ian mentioned, August is fairly unlikely considering, but kind of that September 20th meeting is really the next point on the horizon where there'll be enough aggregate, sort of fundamental data to determine whether it's been a skip or it was truly a pause on its way to something lower. But all that's very far off in the distance at this point.
At least we have August. We can all agree on August. And we're talking about hikes. We're not talking about cuts. And about a month ago, that was the topic of conversation on this show. Can we finally put to bed the topic of 2023 cuts?
I don't think so. I don't think that the Fed is actually going to need to cut in 2023. But when we look at what the market is pricing in, as a market, we love to look at a 26, 27 basis point rate cut priced in by the end of this year and say, aha, that's 100% confidence that the Fed is going to need to fine tune with 25 basis points by the end of the year. I'll suggest something different. It's 100% confidence at 25. I'll suggest it's 25% confidence that we'll see 100 by the end of the year, because it is bimodal. It's either going to go well enough for the Fed to have the soft landing scenario play out, or something's going to go wrong. And when I worry about what could go wrong, I'm really focused on the credit tightening resulting from the regional banking crisis. That's a slow motion hit to the real economy. And as that unfolds, I would expect the Fed will be very closely watching the senior loan officer survey. The one for Q1 didn't show as much tightening as people were expecting. And for that reason, I think there's a false sense of security at the moment for the real economy.
I really like that phrasing, sort of a slow motion hit to the economy, because it feels like we haven't seen it in the data yet, so the market has kind of moved on from worrying about that credit tightening. But George, how are you thinking about it? Have you moved on, or do you sort of share Ian's view there?
We share Ian's view that there's going to be kind of a limited reason, at least in the near term, for the Fed to cut rates. But history tells us once they do, they don't sort of smoothly cut rates in a slow fashion. It's typically fast and furious, and it's in response to something that's hit the economy and hit the data quite hard. And so they rarely have that luxury. When we kind of look at markets, similar to what Ian said from an economic standpoint, but from within the corporate sector, there's this kind of rolling decompression. And it's kind of this dispersion. I'm a corporate bond person at heart. That's where I've spent most of my career. And so we're seeing things like default rates pick up. But it's a very divergent kind of trajectory. And so you're getting sort of small but growing kind of impacts as the effects of tighter policy, higher kind of cost of capital, and importantly, tighter kind of credit conditions, they're working their way through the system. The exogenous shock that's been hit us is inflation, not deflation. And so the inflation fighting strategies are different, and they work their way through the economy at a very different pace, which is why we've yet to see this sort of cataclysmic blow up. Inflation can be good if you're on the right side of it as a corporation or even as an individual, and that's still kind of with us today.
I mean, you've definitely seen that in some of those corporations passing on those higher costs, and they get the boost to their margins. But let's wrap this all into a view on how you should position in your portfolio. We heard from Bob Michael of JP Morgan earlier this week. He's looking at the belly of the Treasury curve.
We feel we've been given a gift in here with the backup in yields. Sure, we swung a little bit low in yields. The market got all excited. Now it's going the other way. We do think that we're going to see 3% across the coupon curve by the end of the summer.
Ian, Lyngen, Bob Michael loves the belly. Is that your view as well? Are you looking maybe longer duration here?
Well, I think it's a good time to play for lower yields across the curve. There was a fallacy in the market for a moment, and that was that effective Fed funds would serve as a floor for nominal rates. And what we have seen is that's not the case when we're this far into the cycle. Regardless of whether or not we're at terminal or the Fed has another hike or two left, the reality is yields are going to continue to compress over the course of this year as the Fed regains credibility as an inflation fighter and break-evens start to drift lower and lower. Now, this is very consistent with the Fed's objective, and it also favors playing for a rally in 5s versus 30s and in 10s versus the balance of the curve. So we're largely on the same page as Bob insofar as we like the belly of the curve, certainly versus the 2-year sector at the moment.
George, I'm going to give you the last word. You have 30 seconds or less. How are you thinking about duration right now?
We like the 5-year part of the curve. It's just enough duration to sort of capture any kind of drawdown in yields. The move up is a very nice opportunity to reload. And as we're watching the curve pivot, we're seeing that as kind of a nice anchor. And so we don't want to go super long. We want to add duration. But if we can kind of coalesce that around the 5-year point on the curve, that fits fixed income portfolios very nice today.
All right, we've got the belly of the curve and we've got August. So let's end it there. Ian Lyngen of BMO and George Bory of Allspring Investments. Thank you both so much. Really appreciate it. Up next, it's the auction block. BMW helps to drive sales to a record in Europe. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, and like the weather in New York today, it's hot. Europe had a record month of May. Bond sales topped 119 billion euros. BMW helped to drive this week's sales. Here in the U.S., companies like CVS and AT&T flooded the market with offerings, making the month of May the second busiest so far this year and the most active May since 2020. And in high yield, private equity-backed sales propelled issuance in May to $22 billion, making it the busiest month for supply since January 2022. Now, even with those red-hot sales, investors remain nervous about credit stress in the system.
Credit's always the canary in the coal mine. And the equity market doesn't seem to be paying attention to it right now. And quite frankly, areas of the fixed income and credit markets, to your point, are not necessarily paying enough attention to the details. When we look at small private issuers, they're defaulting at an alarming rate at the moment. When you look at repeat filers, they've increased quite a bit as well. And so these are your weakest links, and your weakest links always go first.
Joining us now, Stephen O of Pinebridge Investments and Colleen Cunniffe of Vanguard. And Colleen, I want to start with you on that point that credit is the canary in the coal mine. If credit is the canary, what is that bird, if you will, saying right now?
Yeah, well, I think it's saying slightly different things across different sectors. We will say that when we see the earnings season roll on, we did see sort of increasing evidence of some, potential consumer weakness, some mentionings of destocking. So that creates an environment in those two asset classes where we continue to sort of proceed with caution. That being said, as the previous commenter remarked, the leveraged loan market and the private credit markets are a different kind of environment right now. Not a lot of transparency and a lot of heavy weighting towards lower quality credits like single B and triple C. So the canary is singing slightly different songs depending on which sector you're looking at. But I would say the overall theme is approach with caution at the moment.
Well, Colleen, private credit in particular has really taken off. Is that lack of transparency that you get in leverage loans, that you get in private credit, enough to keep you away right now? Is that a concern for you?
It is a concern, but that doesn't, this actually, feeds right into the core strength of the Vanguard Global Credit Research Team, right? We do deep fundamental credit research. So we do believe there's selection opportunities there, particularly actually in the higher end of the leveraged loan market in the double B segment. So it doesn't keep us on the sidelines. It just means we do our work and know what we're investing in.
And Stephen, I want to bring you in here because there was a really interesting research report out from Deutsche Bank flashing a warning for corporate defaults, writing that, quote, our trusted cycle indicators signal a default wave is imminent with credit losses set to consistently rise through 2023 before picking up more sharply in 2024 as the U.S. enters a recession. And they estimate that defaults should peak at about 9% for U.S. high yield by the end of 2024. Is that a concern that you share when it comes to the fundamentals of this market?
I don't share that level of concern. Defaults are certainly going to pick up in a decelerating economy that's been engineered by Fed's tightening of financial conditions. But I think when you look at the underlying composition of what constitutes leveraged finance, as well as the type of economic environment that we're headed into, my expectation is that default rates are simply going to rise from ultra low levels that we've experienced recently, more toward or slightly above historical averages of somewhere in the 3 to 4% territory. And I would say that is far from causing a great deal of concern overall. And I would also say that with respect to leveraged loans, there's a lot of expectations that leveraged loan default rates will be substantially higher than high yield bonds. We also have a different opinion on that despite the preliminary proliferance of single B transactions, the composition, if you look at company by company as opposed to from a top-down standpoint, results in an outcome where you're not going to get that type of extraordinarily high default rates. And in fact, it will be default rates which we believe will be very favorable for market conditions because it creates a bit more balance to the marketplace. And then the last comment I'll make is the prior comment about the lack of transparency. Within the syndicated leveraged loan market, there is tremendous transparency and equivalent or sometimes better than the high yield bond market. I do agree that the private credit market is where there is opaqueness, but I think within the syndicated market, it's a different story.
When it comes to the lack of transparency, and point taken on leverage loans, but talk a little bit more about private credit because, again, especially after what we saw with the banks in March, you've really seen a lot of very bullish commentary about private credit and how that market could grow. But then you have that lack of transparency. I mean, how do you sort of approach that when you think about the potential opportunities there?
I think you need to, first of all, separate private credit in terms of vintages of transactions that were done in the more bullish time period in the last few years relative to what transactions are being formed today. And keep in mind that private credit has migrated, since the financial crisis away from what it was traditionally, which was lending to small and medium enterprises, and really now competing at the lower end of the broadly syndicated marketplace. And if you think about the last 5, 6, 7 years, the highest risk components of what would have been issued in the leveraged loan market really went to the private markets in large part because of the CLO requirements, which limit those, triple C rated transactions. But having said that, I think one of the defenses of private credit is they do have greater levers to work with companies that do get into the stress situations. And so, again, they can manage that default process better. And I think the real opportunity lies in the new vintage of transactions that are about to take place under much more attractive conditions than what we saw in the last 2 years.
Let's switch gears a little bit and move from private markets back to the investment grade, back to the high yield markets, because to that conversation we were having on default risk, Colleen, you take a look at what spreads are doing, and they're not doing much. And I mean, if we go with Stephen's view that, okay, maybe we see defaults pick up, but from historically low levels, do you think that these markets are priced for any sort of pickup of any magnitude?
We look at the valuations in the market as relatively fair right now, right? You've got, high all-in yields, offset a little bit by tighter spreads. So, so from a valuation perspective, we would say it's fair given the current conditions.
And within that overall fairly valued market, I mean, are there any parts of the market that you see as particularly overvalued?
We don't, particularly let's talk about when we were talking about defaults, we don't see any particular, and I'm focusing here on the high yield market, we don't see any particular subsectors that look, bubblish to use a term. We think that the default rates will probably be driven by sort of weaker financial statements, right, running into a slowing economy and higher interest rates. So, at least from a default perspective, we don't have any particular sectors that we've isolated. As we said before, we continue to do the deep work to figure out where we need to be in those sectors. From an investment standpoint, our approach right now is pretty typical of how we would approach this kind of an environment where we're, staying away from deep cyclicals, looking at, and also things that were sort of buoyed by COVID impact, and sticking closer to the non-cyclicals and some of the sort of entertainment and travel sectors that right now seem to be benefiting from where the consumer is.
And of course, there's default risk, and then there's downgrade risk. And you've actually seen spreads for BBB bonds really widen compared to maybe some higher rated tiers. And you also had Voya Investment Management writing that basically they're leaning on higher quality, that the risk of a recession is still hanging over the market, and not being overweight BBBs feels like the right place to be. So, Stephen, staying away from those BBBs. Does that sort of playbook make sense here, or do you think that that risks missing some opportunities in those lower rated parts of the IG market?
I think if you approach investing from a pure top-down standpoint, then being more cautious on the triple B makes a lot of space. But if you approach investing from really a security selection standpoint, what you find is that dispersion has increased within triple Bs. And what that results in better opportunities to pick and choose and produce superior outcomes. So I wouldn't necessarily say avoid triple Bs because you get better opportunities on a credit by credit basis. But from a top-down macro standpoint, I do believe that as we are heading into an environment of slowing earnings, the credit trends are decidedly negative, although we do not expect any type of a meaningful recession, particularly with unemployment levels really low right now and expected to remain low, even with the slowdown. But what happens is when technical trends are negative, then spreads tend to widen. And so broad caution is still relevant and should stay in place.
And actually, it was interesting. I saw in your notes, just quickly here, you wrote that concern is more around short-term technical trends rather than the long-term fundamental outlook. Stephen, just before I let you both go, talk to us about that short-term technical outlook. When should that start to clear up?
You know, I think we're still in an environment where the short-term technicals are going to be about earnings that will, at the top level, you may not see net earnings declining, but if you look underneath, you're going to see a broader subset of companies with decelerating earnings. Mm-hmm. The Fed is going to, I believe, recalibrate market expectations about rate cuts and reduce some of that optimism. So as you look out over the next 3 to 6 months, the technicals are likely to drive spreads wider rather than tighter. But if you look at valuations and if your time horizon is 2-3 years, and if you can look at purchasing a portfolio with that type of time horizon, then the fundamental outlook supports the values.
All right, Stephen O of Pinebridge Investments and Colleen Cunniffe of Vanguard, thank you both so much. Great discussion. Still ahead, the final spread. That's next. This is Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, OPEC Plus meeting in Vienna over the weekend. And then on Monday, we get U.S. durable goods and ISM services. Midweek, UK Prime Minister Rishi Sunak is visiting President Biden in Washington. Another round of jobless claims on Thursday, and then eco data from China to round out the week on Friday. There's also going to be the Bloomberg Invest Conference next week. We're going to hear from some big names like TCW's Katie Koch, Brian Moynihan, and my conversation with Marty Chavez of 6th Street and David Siegel of 2 Sigma. But that does it for us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.